Well, there is a lot of uncertainty. I think everyone kind of knows how uncertain it is with Trump and Musk at the minute. I think the most important thing is to have that strong philosophy, investment philosophy, which we call future quality, so companies that attain and sustain high cash flow returns on investment. And that's our compass, and that's what you really need during periods of uncertainty. What I would really stress, I suppose, is that although it's really uncertain today, you should probably be looking, and we are looking, at the opportunities that this uncertainty brings. 9 months ago, when things were very certain, we took a different approach and actually reduced some of the exposure in our portfolio. So I think in today's environment, we look at it in a positive way. We think there's opportunities that we can see both in the US and outside. We're looking for companies that will grow, and AI has been a huge train of growth, influenced a lot of companies, a lot of them in the US, and all their supply chains. That growth is still continuing. The CapEx is still growing. The numbers have been going up since the start of the year. That really hasn't finished yet. I think what's more interesting is thinking about the returns from that capital expenditure and who's going to benefit. So really thinking about the real world and, is the world ready for AI, and who's going to be applying those solutions? How is it going to be impacting our lives? The market's starting to be a wee bit more discerning about who those winners might be, and that's definitely incorporated within our stock picking. In the last 9 months, we've invested in 3 defensive companies. Invested in a company called Kerry, which is a taste nutrition company out of Europe. Invested in Siemens Healthineers, a diagnostics and imaging healthcare company. And then finally Coca-Cola Europe Pacific, which is the largest bottler outside the US. All 3 very much defensive names. The valuations in defensive stocks has been really attractive, which has partly led to the investment. And as you said, that's moved us away from US stocks, which gets us to a neutral position of where we are today. For example, Palomar, which is a US mid-cap insurance company. It specializes in earthquake insurance. Through better technology and better data, it's able to price the premiums better, being able to grow its market share, and it's been able to do that for the last few years. So quite an unusual company that's definitely future quality in our portfolio. Another one is Hitachi. Hitachi's a Japanese company. People will have heard of it, no doubt. Historically a conglomerate, so very low cash flow returns on investment. A lot of Japanese companies are like that, but the management over the last few years have divested of the low growth, low return businesses, and now it's restructured into something that's a lot more exciting, higher returns, improving returns, that really fits our future quality philosophy.